For this mock exercise, we're going to take a look at the impact of an error on assets, liabilities, shareholders' equity, and net income regarding an asset. Okay, so let's start. Sample company bought a machinery on January 1st, 2010 for $20,000. The machinery had useful life of 6 years and a $2,000 residual value. It is now December 31st, 2012. So if I count the number of years, that would be 2 years later. Sample is in the process of preparing the financial statement and realized that it was the machinery was expensed incorrectly instead of depreciating the asset using straight line. So what we're asked to determine is what is the impact of the error that Sample made in 2010 on the financials of 2012. So that's essentially the question. So first of all, we need to determine the depreciation expense that Sample should have taken each year. So the depreciation expense is the cost of the asset minus the residual value. I'm going to put that as RV. In this case, we're told the residual value is $2,000 and the useful life is 6 years. So useful life is UL. That gives us $3,000 per year amortization. So we know in 2010, so if I was to do the equation A equals L plus SE, in 2010, right, the asset would have been understated by net book value equals the cost of 20 minus the amortization of 3. So we know that the asset would have been understated by $17,000 because it was never recorded as an asset. It was expensed. The liability, there'd be no effect on the liability. And we know by virtue of the balanced equation, we know that the shareholders' equity would have been understated also by $17,000. Now, what is it made out of? First of all, we know that we expensed $20,000. We should have actually, right, expensed only $3,000. So we know that income, we expensed 20, but it should have been only 30,000. So we know that our net income is understated by 17,000. If the net income is understated by 17,000, shareholders' equity is understated by 17,000. Now, in 2011, so if I was to kind of draw what happens the following year, in 2011, the asset would have been understated, but this time the net book value would have been $20,000 minus $6,000, which is 2 times $3,000, because you would have amortized it 2 years. And that the net book value would have been $14,000. That would have been understated. And we know that liability would be no effect. And we know that by virtue of the balanced equation, the shareholders' equity would have been understated by $14,000. Now, what is it composed of? Well, we know that the income for 2011 would have been overstated by $3,000 because we never recorded. We should have recorded the depreciation expense of $3,000. And we know that the shareholders' equity from 2010 is understated by 17, plus the effect on net income would have been overstated by 3,000, giving us a net effect of 14,000 understated. Okay? Now, for 2013, or 2012, sorry, which is the question, what happens? For 2012, the asset, once again, would have had to been amortized. So the net book value would have been 20,000. We're going to subtract 9,000 in this case because the asset would have been amortized 3 years. So we know that it should have been 11,000 and understated. We know that that liability has no effect. And by virtue of the balanced equation, we know that shareholders' equity is understated by 11. And again, we know the composition of that. 2011 net income, or 2012, sorry, net income, would have been overstated by 3. And shareholders' equity, because this is a carry forward number, we know that 2012 shareholders' equity would have been understated by 14,000 plus the current year's overstatement of net income meant that the understatement of shareholders' equity is 11,000. And therefore, the equation will continue to balance. Now, the key to remember is that you can do this for the next 6 years. And at the end of the 6th year, you'll see that the net book value should only have 2,000 remaining, which is the residual value. So at the end of 6 years, which would be 2016, the asset would be understated by 2, and the shareholders' equity would be understated by 2. And if you think about that, that 2,000 represents the unamortized or the remaining net book value of the asset. Remember, back in 2010, we expensed the entire 20. And had we depreciated the asset, we only should have depreciated $18,000 over the 6-year period. Thank you.